This is a weekly AUDUSD setup that shows how to trade persistent downtrends using a simple moving average trend filter plus a multi-period RSI for precision entries and exits. Watch closely. Each yellow circle on the price chart and each matching circle on the oscillator below tells the same story. Wait for a retracement up to the trend line, get confirmation from the RSI, then sell the trend and close when momentum stalls. I will walk you through each trade example step by step and explain the exact rules, risk management, and common mistakes to avoid. What the chart shows. Quick orientation. This is a weekly time frame chart for AUDUSD. The bright yellow line that hugs the candles is a weekly moving average used as the trend filter and dynamic resistance. The lower window is a multi-period RSI indicator made up of several RSI lines with the familiar 70 and 30 reference lines. The chart author only takes sell trades because the weekly slope of the yellow moving average is clearly downward. That single fact sets the bias. Sell the rallies, do not buy the dips. Why use weekly time frames in this setup? Weekly time frames give you the highest probability trend signals. Each bar represents an entire week, so trades capture big moves and avoid intraday noise. Combining a trend filter, the weekly moving average, with an oscillator for timing reduces false entries. The MA defines the direction and shows where price is likely to find resistance on a retracement. The multi-period RSI times entries by showing when momentum up is exhausted and momentum down begins. Trade rule. In plain language, trade only in the direction of the weekly trend. Wait for price to retrace up to the yellow moving average and show a rejection candle or a weekly close near or below the moving average. At the same time, the multi-period RSI must show a bearish reaction, a peak then a downward turn, or a crossover down from above 50 or from overbought levels. Enter the sell on the first reliable weekly close that confirms rejection. Place your stop loss above the recent swing high or above the moving average, plus a small buffer. Exit when the RSI reaches oversold territory or when price hits key support or your reward target. Example 1. Leftmost trade, step by step. Look at the leftmost yellow circle on the price chart. The weekly trend was down. The yellow MA was sloping lower. Price pulled back up and touched the moving average. The highlighted weekly candle shows clear rejection at the MA. Now look at the matching lower circle on the RSI window. The multi-period RSI peaked and rolled over from a relatively high reading. That synchronized pattern, price rejection at the weekly MA and the RSI turning down, is the entry signal. Execution, enter on the next weekly bar open or on the close of the rejection bar. Stop sits above the swing high that formed during the retracement. Target. Close a portion of the trade when the RSI hits the 30 area and move the stop to break even. Let the remainder run to structure support or use a trailing stop. Example 2. Middle trade, step by step. The middle example repeats the same concept. The pair again rallied to the moving average and formed a small cluster of candles that failed to break higher. The RSI formed a lower high and then crossed down, showing momentum loss on the rally. This is lower risk because you are trading in the direction of the dominant weekly trend, and you have confirmation from both price action and momentum. The chart marks the exit point where the RSI drops into the lower band, and price has already created several lower swing lows, so you close and lock profit here. Example 3. Rightmost trade, step by step. On the rightmost example, the price again retraces toward the yellow MA and touches it. The highlighted weekly candle is the rejection. The RSI, shown with multiple colored lines, peaked and then rolled down to below midline. The trader closes the trade when the RSI reaches oversold and price finds support. Notice how each example captures a large, multi-week directional move. This confirms the strength of trading with the weekly bias and waiting patiently for the right setup. Why the multi-period RSI is useful here. Single-period RSI signals can be noisy. Using several RSI lines together gives you confirmation across slightly different momentum windows. When they all turn down together, momentum is clearly shifting. Look for the cluster of RSI lines to top out and decouple from price before you enter. That alignment increases probability and reduces false breakouts that occur when only one RSI period reacts. Concrete entry and exit checklist. Copy this. Weekly trend, down, MA slope, negative. Price retraces and touches or slightly pierces the weekly moving average. A weekly candle shows rejection at the MA, long upper wick, bearish close, or bearish engulfing. Multi-period RSI peaks and turns down or crosses below 50. Enter sell on confirmation bar close. Stop loss above recent swing high or above the MA plus buffer. Exit part at RSI near 30 or first major support. Trail the rest or exit fully on a reversal signal. Risk management. How to size trades. Never risk more than 1 to 2% of your account per trade on weekly setups. Weekly trades can swing widely, so position size must be conservative. Use the distance from your entry to the stop to calculate position size. If the stop distance requires too large a position to reach your desired profit target, skip the trade. Protect your capital and keep a strict risk per trade so one loss cannot wipe out multiple winners. Common mistakes and how to avoid them. Do not enter before the weekly candle closes. Weekly charts require weekly confirmation. Avoid chasing price that is far above the MA with no evidence of rejection. Do not place stops too tight. Weekly volatility is larger than daily volatility. Do not ignore important macro events. A central bank shock or rate announcement can invalidate technical patterns on weekly charts. Finally, do not trade without alignment between price action and RSI. Advanced refinements and exit ideas. You can refine exits by using support zones from horizontal levels, previous weekly lows, or ATR-based targets. Another option is to scale out. Take 50% at the first target when RSI reaches low 30s, move stop to break even, and let the remaining position run with a trailing stop above swing highs or the moving average if it flips. Watch for bullish divergence on the RSI as a signal that momentum may be reversing and consider closing early. Recap and final tips. This weekly setup is simple but powerful. Trend filter with a moving average, and timing with a multi-period RSI. Trade only in the weekly trend direction. Wait for retracement to the MA and a confirmed RSI turn. Use clear stop placement and conservative sizing. Patience is the primary edge on weekly charts. This is a trend-following system that uses moving averages to capture huge amounts of pips with simple rules. Let's go step by step and break it down. First, at the very top left of the chart, you can see the point where the 10-period exponential moving average crosses below the 20-period exponential moving average. This crossover is the main signal that the market is shifting from an uptrend to a downtrend. When this happens, it gives us confirmation to start looking for sell entries. Now notice how the chart highlights each trade. For example, the very first short trade after the crossover produced 267 pips. That means if you had taken that trade, you could have gained 267 points of profit just by following the rules. After that, the next trade gave 200 pips, then another 119 pips, followed by 110 pips, 141 pips, 150 pips, and finally 140 pips. When you add them all up, that's a total of 1,127 pips from only 7 trades. This shows how consistent and profitable the system can be if you stick to the plan. Now let's talk about the rules shown in the text box on the chart. The first step is to wait for the moving averages to cross. Once that happens, you only look for trades in the direction of the crossover. In this example, since the 10 EMA crossed below the 20 EMA, we only take short trades. The second rule is to wait for a pullback. The price will often move down, then retrace back toward the moving averages before continuing lower. This retracement is your opportunity to enter a trade. You want to sell when the market pulls back close to the moving averages and then resumes the downward move. The third rule is stop loss placement. The stop loss should be placed above the most recent swing high if you are shorting. That way, if the market reverses and breaks above that high, your trade is protected and you won't take a huge loss. The chart also gives a practical tip. If you are trading higher time frames like the daily chart, you can set a fixed stop loss of around 200 to 300 pips depending on market conditions. This keeps your risk controlled while still allowing your trade enough room to move. Notice at the bottom right of the chart it says, all trades entered here. Stop loss hit. This shows that not every single trade will win and losses do happen. But the key is that the winners are much bigger than the losers. That's why this strategy still produced more than 1,000 profitable pips, even with losing trades included. So, the big lesson here is that by following a simple moving average crossover system, waiting for pullbacks and using proper stop-loss management, you can capture strong trends and grow your account step by step.